Welcome back to this monetary policy special. We have been speaking with the Executive Director of HDFC, V.S. Rangan, Head of Emerging Markets Economic Research at JP Morgan, Jahangir Aziz, Chief Economist at ICICI Securities Primary Dealer, A. Prasanna, Managing Director and Head of Fixed Income at HSBC, Manish Vadawan, and State Bank of India's Deputy Managing Director, Prashant Kumar. Well, Mr. Kumar, now to you. This big pushing the envelope in terms of market development, asking banks to link retail loans to external benchmarks, will it handicap you because your cost of money is not benchmarked, but your low lending rates are going to be? Will you be able to manage this?
No, this is one area I think which we need to discuss and debate upon, because if you see the majority of our liabilities, they are from the deposit, they are not from the market. So in that scenario, like our deposit costs would not be having any bearing on our lending rate. So going forward, if our lending rates, and we are talking of the retail, which is almost like 60% of our balance sheet, and if they are linked to the external benchmark, then we need to see how we are going to manage the profitability part. But this is something which we need to discuss and come out with certain measures.
Okay, now I don't know if the NHB will follow suit. Logically, it should. Why should only banks be offering home loans linked to external benchmarks? What if the NHB follows, Mr. Rangan?
No, there are two, three. I agree with Mr. Prashant Kumar that, the liability side is relatively fixed for most of the players.
Yes. And
therefore, to make the asset side floating against an external benchmark is going to be a challenge. Having said that, the market, the most liquid market is probably the OIS market, and that also you have large liquidity in the 1 year and other segments.
That's right.
But the key issue is that a retail loan borrower, he may not actually understand a lot of these benchmarks, and the way the volatility will happen in his interest rate would also be quite sharp, because today if you look at the MCLRs may change, let us say 4 times in a year, or maybe 5 times in a year. But if you really link it to the external benchmark, it can change almost every month, and also it can change very significantly over 1 month to the other month. So that is going to create a lot of volatility as far as the customer is concerned and his understanding is concerned.
Okay.
I can see one bright side in this is that typically for us, people may start offering fixed rate loans, 1 year fixed, 2 year fixed, or 3 year fixed, which can become more competitive or more attractive from a customer point of view also.
Okay.
So you may probably have, loan market coming back on a fixed rate basis. May not be for 10 year fixed or things like that, but ideally it could be a 1 year, 2 year fixed.
Fair enough.
Fixed type of market.
I somehow can never escape the feeling that I do feel cheated on floating rate products. They never seem to float. They rarely ever did when I had a floating rate loan. But let me come to the point where I was really irked. I know that there is something called this purity of principle, the Jan Tinberger rule, that you use one instrument for one target, or have as many instruments as you have targets. Jahangir, is this the only way to tackle this liquidity leakage and the purchase of bonds? 3.2 trillion or 3 trillion purchase, that's almost 60% or 70% of all the bonds that will be issued by the government on a net basis. Is there not another way to tackle this? This seems like practically monetizing the deficit.
Right. Look, so we can debate, the purity of the measure, but let's not forget that in the past, the RBI has regularly done this.
Yes, and they were criticized for it.
And so, every time the government has become profligate, hasn't brought down its fiscal deficit on its own, sooner or later the RBI has come to its rescue. This was done under previous governors. This is being done under the current RBI. And I don't really think that this practice is going to change until unless there is an actual Fiscal Responsibility Act or Fiscal Responsibility institution that curbs the hands of the government. So, we can go back and forth on whether this is the right thing or the wrong thing to do, but this is something that RBI has consistently done every time. So just to give you a sense, back in May, I think we turned around and said that, look, this year is going to be one of the largest OMO purchases, given where...
But why not CRR then? Then why not CRR?
Well, I think on CRR, look, it is down to about 4%. So I think you want to keep some firepower.
Okay.
In the event something extreme happens.
Okay.
And I'm guessing that the CRR cut to them is seen as a more permanent way of injecting liquidity rather than these temporary injections of liquidity.
Fair point.
But I know, So
I guess if you are the government's merchant banker, you don't have much of a choice. Prasanna, what are your thoughts on this? Did they have another way out? Is this like kind of succumbing to the government?
Well, I think as an instrument, I guess you can say that open market operations are used by many central banks. I think the question is in which part of the curve you're intervening. So as long as the purchases are largely limited to the short end, I think it's fair. It's a fair practice. But of course, the problem in India, of course, is that the market trades only at the long end. So the RBI is forced to buy at the long end also. So there is definitely a moral hazard here. But I buy your point. I think what you're saying is if you buy up 75% of the borrowing program, then what are the fundamentals getting priced? Then it's purely a demand supply. So maybe I think one memo to Deputy Governor is he shouldn't come and lecture bond market and how we are not pricing risks, right? Whether it's inflation or fiscal deficit, right? Okay. Maybe they should look at the mirror themselves. And the second thing is, I think the lesson to be learned is that when RBI did OMO sales, if you remember last year, probably I think that was a mistake. So it looks like in India, anyway, currency leakage is fairly high. And the BOP situation is such that over the last few years, we usually end up on an average, we end up with a very minimal balance, so very minimal positive balance, which means that the FX route is not there for RBI on a prolonged basis for them to add reserves, which means that the OMO purchase is the only option. So I think the lesson to be learned is also not to do OMO sales. And then if you do that, I think the problem kind of gets doubled actually.
Yes, there is, but I guess at that time you can't see so much into the future. You probably think demonetization has worked and so much cash will not leak.
But that is their job, Lata,
yes.
But that is their job actually.
No, I take your point. I mean, I feel that this is simply too much of purchases, but I guess at this stage there isn't much that they can do till the end of the year. On the SLR cut, any thoughts, Manish? Will that have any impact on the bond rates, or will it be taken in the stride because of the overall dovishness?
Yeah, I think if you look at a bit of history, the SLR was at 19 or 19 and a half, but the overall SLR maintenance by the system is around 27%. So I really don't think there's any difference which is going to get made because of SLR cut.
Okay.
As you said, it would be taken in stride, and overall requirement of the system is far higher because of the LCR. And I would just take 30 seconds more to add one more point. What you were asking about liquidity, please see it in the perspective of what has happened in the last 1 year. The intervention in FX spot markets is around $30 billion, so it is approximately 2.1 trillion INR. The currency leakage is around 3 trillion INR in this year.
Yes.
So total, leakage of liquidity is around 5 trillion, and that is going from the balance sheet if you look at it.
Yeah.
And that is why this OMO thing comes up. So this debate of CRR versus CRR is, I think, quite a sanguine kind of a tool and for macroeconomic stability.
Fair.
I suppose they don't want to bring it down below a certain level.
Moral of the story, profligate governments should be happy when there is a run on the currency, because that will mean that the central bank will actually do more OMOs and help relieve their stress. Well, all told, I think the RBI would deserve a lot of kudos for this policy. The general takeaway has been that it has tried to be as dovish as it possibly could without putting the statement in black and white, thereby giving itself perhaps some elbow room in case there were ugly surprises either in the global rate cycle or in crude prices. It's been able to give a lot of comfort to the NBFC and the debt markets without doing anything unwarranted or unorthodox, like actually giving a line of credit, but almost coming very close to comforting the market. And finally, it has been able to push the envelope in financial sector development by trying to link loans to external benchmarks. Hopefully, the next experiment will be to link even deposits to external benchmarks. I would think that the RBI has come out with flying colors under the circumstances. Thank you very much, Prasanna, Manish, Mr. Prashant Kumar, Mr. Rangan, and Jahangir for joining me in this conversation. Let me start first with you, Shaurya, because this could be, the most disputable thing. Is corruption waning? Is the state getting less powerful in some areas, less effective? Now, I just want to take one thing which is dominating headlines now as a trend. It may be short term, but it's very relevant for businesses. The state may have less power to perhaps give out things. Now, as you point out, it's reined in by the courts, by media, by opposition. But it's also become a very investigative state. Everything is disputed so much that, cold scam, you have IAS officers in prison. You have a series of investigations against all kinds of bankers, even independent board members and banks. So would businesses worry that no decision will get taken simply because of investigation 3 years down the line?
Yes, I completely agree with you. And I think that's what I had alluded that, we don't know where this new order is going to sit because we've disrupted the old order. I don't think any particular party or politician has done it. I think it's systematically happening, because of the reasons that you mentioned, greater accountability, greater transparency, judicial activism. We are now in a situation where exactly what is happening is that the government, the state is becoming increasingly defensive, and therefore it is becoming more intrusive. And therefore nobody wants to take a decision. So yes, this is a big challenge for business. And the answer to this also does not lie in the hands of the business. To some extent, it lies in the hands of the electorate. It lies in the hands of the people. The
electorate gave a resounding victory. I mean, the electorate gave a 335 seat backing, something which has not been done since 1984. I think that was the last time we got
and that's what I said. And you interpreted that as a mandate to do this, or whatever your priority. The politician did not interpret that mandate as that. That is what I said. A politician will interpret his mandate depending upon, at times, this, but also there may be other political priorities. The politician interpreted as saying, what are the things that I need to do to stay in power? And therefore this or other things like this may go down in priority. So this is the state of flux that we are currently going through.
Okay. Let me toss the same thing to Mr. Jaishankar, not the least because he has seen both bureaucracy and the political class at close quarters. Do you think this sense of indecision, while I agree with many of the trends that you have spoken about, for me this trend of indecision is going to hamper business decisions a great deal. You see it going away? Is it peaking off because there's so much investigation at some point you just want to get going with things?
Well, look, I would say in all honesty, those who want to make decisions will make decisions. Those who want to rationalize indecisions will use it to rationalize indecision. So I'm not your question sort of suggests a very paralyzed polity. I'm not quite sure I agree with that. Okay. On the one hand, yes, I accept, or I note at least a lot of what you said. I think there's the other side of it as well, which was that we are moving, there's more data out there, because of that, there are processes out there which make it, a lot of things which would have stayed undercover don't stay undercover. So, I think Shaurya has got one point, which is society is changing, techniques are changing, technology is changing, priorities are changing. So, some of what you say will happen.
Okay, well, if there are people who disagree that there isn't paralysis, I'm very happy. But I mean, I thought Shaurya almost agreed that there is a great deal of paralysis in bureaucracy and in banking. But at least two areas where there's investigation.
Mr. Jaishankar also, that in areas where the politician had the priority, he got it done. Jan Dhan was important, so it got done. Swachh Bharat was important, so it got done. How does
GST got done?
Yes, GST got done. So how is the question for business is that how will the politician put his priority? As because there is priority, there are also riots happening because of the cow.
Adrian concluded his sentence by saying, if trade disputes get resolved and China recovers, he began with that. Is this really a 90-day dispute? The way in which the Huawei case has progressed, clearly this is not a trade dispute. It's going to be disputes across, several frontiers, across all frontiers, intellectual property, it'll go on and on, geopolitics, South China Sea. So do you think that we are going to live with a US-China dispute, not for 90 days, not even for the term of a president, but probably like the US-USSR war for a generation?
Well, first, I just want to make sure I got what Adrian said correctly, because I think he identified two problems. One is the trade issue. One is the Chinese slowdown, and the two are not necessarily correlated. There's a Chinese slowdown, which is autonomous of the trade, and in my view, actually, perhaps even more worrisome than the trade issue itself. But coming back to it, will the trade issue remain trade issue? Will it stay 90 days? My point was it has ceased to be a trade issue. It is today, yes, it's a trade issue, but it has also become a technology access issue. It's become a technology control issue. It's become, well, does the WTO work or not work issue? It has assumed political dimensions, strategic dimensions of various kinds. So I think we are seeing something very profound. We are seeing the rise of a new superpower, a new global power certainly, and the Newton's third law of politics applies. If something big happens in politics, there's going to be a big political reaction, and that's what we are seeing actually happen. So I don't think Americans are anymore treating this as a trade deficit issue. I think they see China, particularly if you see the target, look at Peter Navarro's writings. I mean, a lot of it is make in China 2025. It's a challenge, and last week, the Americans have identified 14 emerging technologies which they are considering for export control. Now, that is clearly a certain direction the world is going. And export controls are very much terminology of the Cold War.
If it's not a 90-day effort, then would you have to revise your thesis that China would still be able to recover and do better next year?
So the slowdown in China is about domestic policy.
Yes.
It's not about trade. The trade numbers actually out of China are still quite strong. So the contribution is coming through there positively. So I see them as independent. If you wanted to link them, then I think you would stretch it by saying that the Chinese might want a little bit more cushion on their economy, so would be more inclined to ease. I've been struck by the Trump administration, how they take us to the brink, and when you start to think about Trump dealing with AMLO, the new president of Mexico, it was quite extraordinary. Actually, he's not even president, he's not even elected, he's not even sworn in, but they've come to a deal with Mexico very quickly. Because one of the great advantages of TPP, and they spent so much time on this Trans-Pacific Partnership, is they know the deal that needs to be signed. And when they have the willingness to sign it, it goes ahead. And so we have, as described here, we have a geopolitical dispute going on with the trade part to it. I think you could continue to have protected technologies not being sold to the United States, but you could still have greater clarity about what the tariffs are going to be. And let's not forget that US jobs are being lost already because of Trump's policy. It's costing General Motors $1 billion extra per year, the US trade policy. The reason that they've closed factories is because of that. And I know that Trump doesn't want to attack who's a very good CEO, but that's not the facts here. And I think, he also runs a political risk when people that voted for him start to lose their jobs, and maybe as they lose their jobs, they'll see the reality around it.
So your base case is that it will not, the 10% tariffs don't become 25% tariffs. That's the base case of your investment thesis.
Yeah, so I think that the can will be kicked. And there is a chance, as we saw with NAFTA, that renegotiations happen pretty quickly.
There is a political economic polemics in your analysis, and I'm trying to...
But they could coexist.
Yeah.
Because...
No, could they? Because, I'm just trying to compare it with the US-USSR and the US-China relationship. There, they were mutually exclusive. Here, they are deeply intertwined. So, if China slows, then US also slows because China is a big market for the US. So, will they see the rationality of that, or will both grind lower because they're intertwined and they are still adversarial? Okay, first you take the...
So I think this is the risk, isn't it? Because Trump is fixated on the trade and the current account deficit. Trump has put in place a big fiscal stimulus, so the savings rate of the federal government is going down. There's no change in the household savings rate. So the US total savings rate, savings deficit goes up, the current account's going to go up. And if he's fixated on that, his current course of action is not going to resolve it. If he can be distracted to look at other issues and they can negotiate on the particular issues with the Chinese, then I think we can make progress. But there is a failure of the economic logic around this, which we need to keep on going back to.
Well, so we hope that brinkmanship will lead to people moving away from a position of confrontation. One more question, and then I'm coming to issues Indian. How would you expect India to tackle this? Foreign businesses investing in India would want to know that in the US-USSR era, India really tilted, although it was a non-aligned bloc, it was a non-aligned bloc which had more USSR friends. At this point in time, how would foreign businesses want to outguess India's behavior? Does India tilt? Which way? Does it have the wherewithal to not tilt at all?
No, look, I would, let me just go back very briefly to the previous question. Okay, if I were to, and today it takes a bold person to make a prediction, but I would make a prediction which is that the big problems will continue between US and China, but there will be interims, road stop solutions, because both will have common interest, for example, in stabilizing markets. Both will have some common interest in stabilizing trade. So you're going to have partial solutions, but a larger overhang which will continue to be a problem. On the question of what does India do in all of this, I think there are two sets of responses. One is, look, there are a lot of things which we assumed other people would do, and they won't do it, and therefore we will have to do it. So there's going to be a greater role. You'll have to step forward on a whole lot of things. We've already seen that, when something goes wrong, there's a war somewhere in Yemen, there's an earthquake in Nepal. So the world's not going to come. Either we do it or nobody does it. But the other part of it on US-China, I think, in a sense, do bear in mind, we have a big trade deficit ourselves with China.
Yes.
So in the sense, if China actually is more sensitive to global opinion on trade, it's not bad for India. In fact, we could, in a sense, be a beneficiary. To some extent, if China has been very America-centric in the last 15, 20 years, understandably. I think today you're seeing a correction in Chinese policies. You see Chinese reach out to India, you see Chinese reach out to Japan.
Yes.
You've seen much more, I've heard more positive talk from China on trade in the last 1 year than I've heard in 5 years when I was ambassador there. So I think what's going to happen is everybody will try to get a little more margin vis-a-vis other people, and in a sense, who plays the game well. I see an opportunity here. I see an opportunity with American companies who are looking elsewhere. I see an opportunity with Chinese companies which want to go out of China, and in my view, we should welcome them.
Okay. Shaurya, Obviously, one of the things that the bus that India missed, one of the many buses that India missed was getting into the global supply chain and trying to take advantage of the Chinese growth. Now that that supply chain will break simply because of the competition between US and China, do you think the Indian political class and the bureaucracy is seized of the opportunity and will be able to snatch some of that supply chain or snatch opportunities which perhaps will come our way because will come the way of other emerging markets because of the dispute between US and China? Is the awareness?
I don't think they need to have an awareness, but the answer is yes, because I think the way this, with this GST coming and with, the framework for this is already laid. And you can now already see the huge amount of competitive federalism that is happening with the states competing with each other. So while they may or may not, they don't need to understand this full dimension. What they are going to do is that I'm seeing even small states now compete to get into this supply chain. They want to make themselves as investment destinations and offer companies a chance for them to build and produce there. So I think by default it will happen. The enabling environment is actually becoming there, was already there now to a great extent with this GST coming in. So I think that India should seize this opportunity. Whether India will go this in a concerted bid as a nation, well, that's not how our polity is structured. We don't sit and decide now there's a huge opportunity, let us take it. What we have got to do is let our states now compete. We are sitting in Maharashtra the other day. The Chief Minister was telling that, by the time, today Maharashtra is receiving about 70-80% of total investment in India. By the time India becomes $1 trillion economy, plugging into the global supply chain, Maharashtra in itself will become a $1 trillion GDP. So, I think the states will take a lead on this.
Okay, well, we have to see about state chief ministers and their ability to drive economic growth to that extent. That certainly will be one trend to watch for, how powerful our state chief ministers and how capable they are. Adrian, I take your point about EPS growth in India simply not firing. I think I must have spent the last 5 years saying that EPS growth comes in the second half, and it doesn't come in the second half. This year, again, we are waiting. The second quarter was good, but people are not still so confident of the second half. How confident are you about next year? Do you think, financials are at least getting rid of the NPA problem? If you actually look at Indian EPS growth, ex-financials, the growth is not all that bad. So is there a positive surprise in FY20?
So this is like a game of poker. So the double bluff is that the investors that look at the number and say it's too high will probably be saying, well, now that oil has come off, the rupee is recovering, the chance of an interest rate increase is lower, then the level of downgrade is probably going to be lower than the market was expecting. So it's the sort of double bluff will be a bit better,
yes,
but it's still going to be a downgrade.
Not double, actually, I would say quadruple, because we've gone through it for several years.
That's not too convoluted description, but I think that's basically what's going to happen. The other thing to remember here with the valuation point is that the household savings rate, although it's declining, is still high. The inflows into equity mutual funds still remains quite strong. And unfortunately, there's a political inability here to do privatizations, or to use a more politically sensitive word, divestment. So the supply of equity, even though the market cap here has gone up from 69 billion to 2 trillion, which is sort of 18% compounded rate, the supply of equity at a large scale that might come from government doesn't exist.
It's time we took audience questions, sir.
Vivek Mittal from Greencoat Capital in the UK. What is the role of domestic capital in the doubling of GDP that's to come? India's done a great job over the last 25 years as a country in making itself attractive for international capital. It's always been outwardly looking. But there's a $3 trillion capital market here, which will also double. But there don't seem to be too many great routes for that capital to play in the growth of India coming forward.
Shaurya, you want to take that?
Okay. But I'll try and answer it to the extent that I've understood the question, but then you can carry on. I think if your question is that is domestic capital now being used for India's growth? Well, I think, the very fact that, post demonetization, we've seen this huge amount of capital that was existing outside the Indian formal banking system coming into our equity markets is one indicator of, the use of this domestic capital to fuel India's economic growth. We should have seen much more credit growth from our banking system, but obviously because the issues there continue to be unresolved, we have not been able to create the kind of credit growth that should have happened from our own domestic institutions. But hopefully that's the next thing that will there. And then of course finally, India continues to be one of the most attractive FDI destinations. So foreign capital will continue to play an important role in India's overall growth.
At least the story of India's growth so far is entirely domestically fired capital. There's very little role that foreign capital has played. It's marginal. And now I would assume after financialization of savings, I mean, I'm not saying the way in which we saw the march of money from banks to mutual funds will continue at the same pace, but it looks like it will continue. Do you really doubt the coming of domestic capital? Isn't it only increasing?
So I think the question is asking really about whether that domestic capital gets more sophisticated and starts to finance assets that are difficult for a mutual fund to finance, difficult for a bank to finance. And some of the changes, the reforms that have gone ahead in the last 5 years are very important here. So targeting inflation means that we have much lower volatility in inflation and thus interest rates. Very important for long-term financing. And then we have the Insolvency Act. And if you're going to be lending money, providing equity capital, you need the right legal framework. And I think some of these soft issues have only been more recently addressed. Now, you can put in place an Insolvency Act, but you're not going to have judges that know about insolvency or lawyers, might have some accountants. And that sort of soft part of that, again, will just take a little bit more time. But I'd be very optimistic about how this is going to develop because of these reforms. And sort of to address in terms of investment opportunities, GST is a common market in India. You will become part of the global supply chain because I can set up a factory here and address the whole of the Indian economy. Nearly 3 trillion, not each individual state, and then pay octroi every time I cross borders. So I think there's lots looking forward that would make me very optimistic about some of the more sophisticated capital structures that you might see in the United States and Europe being applied here.
This is Praveen from HDFC. I have a question to Adrian. So now people are talking of slowdown in growth in the world economy and everything, and now the talks have been there that there will be a recession. Then what are the triggers you see there will be a global recession, and where the India will be placed in that scenario, and how the impact will be there on Indian growth and the Indian sector?
Thanks, Praveen. So if we think about recessions in the past, up until 2000, recessions were typically centrally bank-driven. So you would have a build-up of inflation, the central bank would tighten policy, reduce demand, they wouldn't finesse it, and you would go into a recession. So that was the classic story. In 2000, 2001, it was an overinvestment. It was a bubble in the tech space. And then what we had in 2008 was again a bubble in a real estate market, inappropriate risk-taking within the financial system that caused that as a shock. At this point in time, I'm struggling to see bubbles out there. And there is a credible argument, but I would suggest probability of this is falling, which is having a very tight US labor market classically could be inflationary. US wages are going up at about 3%. So we should pay a little bit of attention to that, and that could force Powell's hand, but that seems very unlikely. I don't see any inflationary issues in EM on a GDP-weighted basis, nor do I see it in Europe or in Japan. So if you think the market's going down because they're worried about recession, then I'd be buying markets on that.
Okay, so you don't see a recession at all? It's only going to be a minor slowdown?
I don't see a recession in the forecastable future. I will not predict the end of recessions.
Okay, thank you very much. I'm told that we're already out of time, so no further questions.